right. Well, hello and welcome to tonight's webinar, Selecting and Managing Your Investments, presented by Charles Rotblut, creator of the PRISM wealth building process. My name is Jenna Brashear, your host for this evening, and I want to thank all of you for attending. And we're really excited to showcase step 4, Selecting and Managing Your Investments of the PRISM wealth building process. And I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And if you have any questions for Charles or I tonight, please feel free to send them in via your GoToWebinar control panel, which is located on the right-hand side of your screen. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings, or you can consult the GoToWebinar website for support at gotowebinar.com. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with any of the links to the presentation's handouts and any other resources that we discussed tonight. And for just our new viewers, I'd like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And as I mentioned before, tonight's webinar is an interactive event. Therefore, we will be answering questions as well as polling the audience on various topics throughout the broadcast. So without further ado, sit back, relax, and enjoy tonight's presentation. Take it away, Charles.
Thanks, Jenna. Thanks everybody for joining us this evening. It's we've got a wintry mix here in Chicago. Hopefully it's a little bit warmer where you're at. Jenna and I were just talking. We had some wet snow today, so it's Chicago. The calendar might say spring, but it's certainly still winter here. But we're going to try and warm you up a little bit with some PRISM. So today we're going to focus on really step 4 of the PRISM process, which is selecting and managing your investments. And for those of you who are new to the PRISM process, it provides a framework for really aligning your investment decisions with your goals. And so what the 5 steps of PRISM do is they'll actually empower you to invest in a way that actually puts you on a direction, on a path to achieve your goals, but also gives you the confidence to follow that plan. So what PRISM is, it's really a framework. We're giving you the tools you need to build your own personalized plan, but no two people will have the exact same PRISM plan. And the reason is it's designed to be very personal. So we'll give you all the tools you need to help you make some key decisions, but it's still up to you to determine what exactly is the best financial plan given your situation, given what you're trying to achieve, and obviously given your risk tolerance and your preferences as well. And as I said, tonight we're going to focus on step 4, which is selecting and managing your investments. So the PRISM process, you can think of as a big funnel. At the very wide part of the funnel, you have your goals. What are you trying to achieve? And then we start narrowing it down. What's your tolerance for risk? What's an appropriate allocation for you? What are your investment management preferences? And after you do all that, then we get to the process of selecting investments. And the reason why is once you've made those 3 previous decisions, gone through those 3 previous steps, you really will find out you've narrowed down the choice of investments, and it actually becomes easier to find the right investment for you once you have worked through the 3 previous steps of PRISM. And one thing I will point out, as I said, PRISM is really personal. And tonight I'm going to give you some rules you can use in your own personal plan for identifying investments. But I do want to point out that when you're looking at this, realize you're not trying to necessarily get the highest return, or perhaps your goal is to get the most amount of income out of your portfolio. Rather, your goal is to develop a portfolio that you can sleep with at night, a portfolio that you go to bed, you're calm. No matter what the market's doing, you're going to get a good night's sleep. And that really, this optimal strategy is really the one you can stick with no matter what the market's doing. So if there's, obviously war in Eastern Europe, if there's concern here in the US about rising interest rates, you know you have this plan, you know it's a good plan, and you know it's one you can stick with. And that's why we talk about PRISM being very personal, because you really want to come up with rules and a plan that's appropriate for you. So we're going to give you some guidelines for selecting investments, but it's still up to you to figure out what exactly is the right approach to investing and what approach can you stick with both during good times in the market and both during those times where it's not so much fun to be an investor. So let's give you some basic guidelines here. When it comes to selecting stocks, start with your allocation needs. What part of your allocation are you trying to select an investment for? What parts of your allocation do you need to fill or perhaps replace an investment with? You also want to use your preferences from step 3 in terms to help you select a right investment. So perhaps you went through our preferences and realized you're an index investor. That's fine. Then focus on the fund rules, particularly as they pertain towards passive investments. Perhaps you're someone who likes to roll up their sleeves and really get into securities and really do the analysis on stocks, perhaps bonds. That's great too. Focus on those rules tonight. And always establish the rules to help you select the right investment based on your preferences, based on your allocation needs, based on how you want to actually invest. So we're gonna give you some good guidelines, but it's up to you to decide what works best for the type of investor you are. And once you're done, I encourage you to actually jump over to the community, or you can jump onto the planning section of AAII.com and you can access this handy worksheets. This is part of step 4. It gives you the ability to write down your rules for buying and selling. And the reason why we want you to write it down is because it takes the emotional component out of it. When you have pre-written buy and sell rules, you're going to be a more disciplined investor. Now, some people would rather use checklists than written buy and sell rules. That works well as also, but the idea is you're not trying to keep things in your head. You have the set list of things you're going to do every time you look at an investment, whether it's to buy it or whether it's to decide, am I going to keep it or am I going to sell it? And having these rules that you follow routinely will make you more disciplined. It'll take the emotional components out of your investment decisions, and it will lead to higher returns over the long term. And Jenna, I know we have a poll real quick to give to our attendees tonight.
Yeah, let me grab that right now. So our poll for tonight is, do you have written buy and sell rules that you follow? And you can go ahead and start voting. Give you a couple minutes.
Absolutely. And Jenna, while we're waiting, I'm sure it's probably a little too early, but have any questions come through yet?
Yeah, actually, there's a couple
Oh,
here. Let's see.
okay.
Yeah, let me grab that real quick. So can the PRISM Academy be applied to index investing?
Absolutely. Actually, when we talk about preferences in the last step, and you can find the webinar on our YouTube page, we actually do talk about it, and that is a preference. And for a lot of investors, that's actually a really good strategy. So absolutely, if that's your preference, you definitely can incorporate it. And we'll get into that a little bit tonight when we talk about funds and ETFs.
Yeah, let's see if there's anything else. I think a lot of them are actually talking about, well, I just wanted to mention that because we did get a couple questions about, will you get the resources from today's presentation? And yes, we definitely will have those ready and available. They'll be going to either your email or you can access them on the YouTube description that will be posted tomorrow afternoon. All right, I'm going to close the poll now because
Sure.
looks like 76% of people have voted.
Great.
And I will share the results. Excellent. So it looks like about 78% said that they don't have any buy and sell rules that they currently follow, and 22% said they did. Interesting.
Wow. Okay, great. Well, we're going to give those of you who have rules and those of you who don't have rules, we're going to give you some ideas on how you can create your own rules. And Jenna, before I do, why don't you talk about PRISM Academy real quick? I'll give you a chance.
This basically, I just wanted to highlight that, for when you come into the PRISM Academy, it may look a little intimidating because we have so much content. that is available for our members. But I want to make sure that, if you can start at any time. So if this is your first time, as an introduction into PRISM, and you want to get started on step 1, which is P, prioritizing your goals, and then you can go right in there and go through that section at your leisure. But I did want to highlight that we, for lesson 1 of S, which is step 4, selecting and managing your investments, you can actually view the full course overview. And then it also provides members with an intro welcome video, which highlights what will you learn in this section, and all the things that we'll cover. And then we also have some discussion questions for lesson 1. So what allocation model did you choose back in step 2? So this is kind of bringing up some kind of information that you learned in step 2, which was recognizing your risk tolerance and allocation, as well as in investment, actually a bunch of different steps that we go. And then which asset class groups do you need to find investments for? So any gaps in your portfolio, such as large cap stocks or intermediate term bonds. And then the optional question was, what is one aspect of selecting investments you are unsure about or need more clarity on? So you can go ahead and get into the PRISM Academy and interact with lesson 1.
Great, thanks, Jenna. So we're going to start off tonight with mutual funds. Just to give everybody a quick overview, the order of flow, so to speak, tonight we'll cover mutual funds and ETFs, then we'll do stocks, and then we'll do bonds and bond funds. So let's start with mutual funds and ETFs. Again, that whole idea about starting with your preferences. And we had one attendee ask us a few minutes ago about whether we'll cover index investing. And here's where it comes into play. So in step 3 of the PRISM process, we ask you to identify your preferences. In this case, for mutual funds, do you want actively managed mutual funds? Do you want passively managed mutual funds, meaning index funds or ETFs? And I'm going to use funds interchangeably here to apply to both mutual funds and ETFs, just to simplify things, but determine which you want. Also consider what constraints do you have. You might be a diehard believer in John Bogle, but your 401k plan or perhaps the 529 plan you're investing in for your child or your grandchild, maybe that only has active funds. So consider those constraints. Also think about whether or not you want to have a mutual fund or ETF. I'm of the opinion you should be indifferent, but some people do have preferences for one or the other. And if you have a strong preference that you really like mutual funds or you really like ETFs, that's fine. Just write it down and realize that if you do have that preference, it actually narrows down your scope of investing, because if you really prefer mutual funds or ETFs, then you should only focus on a mutual fund or ETF to fill your allocation needs. And also the tax cost ratio. That is, how much in returns are you losing to taxes? If you're holding a fund in a taxable account, this comes into play. If you're holding it in a tax preferred account, an IRA, a 401k, a Roth IRA, etc., then it really doesn't matter. But if you're holding in a taxable account, it is a consideration. And so you want to factor that into your rules when you're investigating and considering possible investments. So here's some general guidelines for funds. And again, it applies to both mutual funds and ETFs. One of the things you want to look at is how has the fund performed relative to its peers. So you really want to compare apples to apples, and you really almost want to compare Red Delicious apples to Red Delicious apples. You might see a list of top performing funds, and you might see a small cap value fund on there. You might see emerging markets fund on there, and maybe you see something from the tech industry on there. Well, those are all 3 different types of funds. They're all targeting 3 different types of assets. And so to try and do comparisons, you really can't, because each one of those, the emerging markets fund, the small cap fund, and a tech fund, their returns are being driven by the type of investments they target. And so all 3 might have different return characteristics. So this is why in PRISM we talk about starting with your allocation and drilling down an investment process, because if you have a need for a small cap fund, then you should compare small cap funds against small cap funds. Use it based on your allocation needs. If you need, say, a foreign large cap blend fund, then compare it to other foreign large cap blend funds. Everything else being equal, look for lower expense ratios. And the reason why this is important is that for higher expense ratio funds, they need to have higher returns just to get you break even. So say you have a fund that's charging 20 basis points, 0.2%, and another fund charges 100 basis points, 1%. Well, that fund charging 1% has to realize in returns 0.8, has to really 0.8 percentage points better every year in return just to match the post-expense return of the lower expense ratio fund. So as a fund that's charging more has to give you a higher return just to get you to break even with the index fund, and then it has to earn even more to give you a higher return. So that's a pretty big hurdle these higher expense funds have to overcome. Now, if you are seeking an actively managed fund, and those are mostly in the mutual fund area, but we are seeing a growing number of actively managed ETFs. In terms of asset size, they're still pretty small, but we are seeing more and more introduced. You want to look at the R squared value, and R squared basically tells you how much of the fund's performance can be explained by movements in the S&P 500. And a truly actively managed fund's going to have a lower R squared number for its category. So you want to pay attention to that, because if you're going to pay for active management, you want a manager who is being truly active, meaning not that he or she is trading left or right, but they're building a portfolio that doesn't look anything like the index. Because if you want a portfolio that looks like the index, mutual fund side, Vanguard's really cheap. On the ETF side, you can look at Vanguard, you can look at iShares, you can look at State Street, perhaps Invesco. They track the indexes really well. They do it very efficiently at low expense ratios. So you don't want to pay for an active manager whose portfolio is really similar to the index. You want to pay for an active manager who's truly giving you a different portfolio. And most importantly, read the objective. Look at the fund fact sheet. Look at the fund's prospectus. If you have no idea what the fund's actually doing, it's probably not the right fund for you. But what I will tell you is never judge a fund by its name. Always look to see what exactly is the fund doing, because it may not give you the exact portfolio you're necessarily expecting based on a name alone. So do that additional research. And again, going back to the issue about expense ratios and active management, realize that the goal with active management is not just to look at the ones that have outperformed in the past, but also try to identify the active managers that are going to outperform in the future. And it's not easy to do so. This chart I'm showing you on the screen here is from S&P 500 SPIVA, SPIVA. You can just type it into Google, you'll find it. It's free to access on the S&P Dow Jones Indices website. They regularly look at mutual fund performance. And what they found time and time again is that most equity funds underperform the S&P 500. They tend to not only find on any given time span most actively managed funds underperforming the indexes, they also find a general lack of persistence, meaning that the winning funds don't tend to remain winning funds. In other words, the funds that have outperformed in the past often don't keep outperforming in the future. Are there exceptions? There always are. But it's always a challenge of, can you pick the active manager that's going to outperform in the future by looking at past returns? It's not very easy to do. So when we talk about what you should consider when you buy a fund, but there might be a time when you need to sell a fund, whether it's a mutual fund or an ETF. And I will say a lot of what I'm talking here can be applied to closed-end funds as well. One of the things is if you see your fund underperform its peers over a period of years. Now, one bad year underperformance might just be to the mutual fund manager following a differentiated strategy. That can lead to underperformance. But if you go a few years and the fund continuously underperform its category peers, again, the idea of comparing, red delicious apples to red delicious apples and golden delicious apples to golden delicious apples, the same thing applies here. Small cap to small cap, large cap blend to large cap blend. short-term bond and short-term bond, doing those peer comparisons. If you see a fund manager underperform over a period of years, that would be a reason to get rid of the fund. If it gets more expensive, perhaps other funds are cutting their expense ratio and your fund isn't, that might be a reason. Certainly if you see the objective or the underlying index change, we do see this with ETFs, particularly smaller niche ETFs are trying to target a certain sector or a certain industry group. We do see from time to time when they do a sudden shift in strategy. Well, you bought the fund because it was following one strategy, and now it's following a different strategy. So the reason you bought it no longer applies. And also, if there's a manager change, just pay attention to whether how the fund's being managed shifts. What we are seeing with mutual funds particularly is more group management. So it used to be you have a star manager, maybe Bill Miller, maybe Peter Lynch. Now we're tending to see more management by committee. And so you might see the lead manager leave, but there might be a committee in place, a team in place where the transition's smoother. But you want to keep an eye on how the fund's being managed. If you see different types of investments being picked, if you're seeing change in turnover, that might be a reason to consider replacing the fund. Now, how do you find funds? Well, on AAII.com, we have several resources to help you find funds. Two, of course, are our mutual fund and ETF guides. They're included in the February AAII journal, but we update them monthly on AAII.com. If you just go to Investing Ideas, or if you just get to the February journal, you will actually have a link to the online database. We have over 24,000 mutual funds on the website and approximately 2,700, I think, exchange traded funds. You click the Investing Ideas section of AAII.com. You'll also find other mutual fund tables and ideas there. Our mutual fund ETF evaluators, you can find that through the ETF side, or through the Investing Ideas side. The mutual fund ETF evaluators, they allow you to do side-by-side comparisons of two or more funds. And yes, you can pair a mutual fund against an ETF in those evaluators so you can see how they look based on returns, based on expense ratios, etc. If you're an A+ investor subscriber or you're an AAII Platinum subscribers, you also have access to our mutual fund and our ETF screeners. We are working on changing the interface for how they're actually used, working on enhancements for them, but they exist on our website right now, and they're a very great tool. They're great tools if you want to narrow down and you have certain characteristics you want to use. And again, all of this is available on AAII.com, including this top bottom performing funds that you see an image for on this slide. And Jen, I know we have more about mutual funds on PRISM Academy.
Yes, definitely. So we do have correlating lessons 2 through 4 in the PRISM Academy that deals with mutual funds and ETFs. So lesson 2 focuses on narrowing down the fund universe. It actually has it has a checklist that you can follow along and gets a little bit more information. Lesson 3 is about finding a fund and where to start. That also does have a checklist. So it basically highlights all of the resources that are available that Charles just mentioned, as well as corresponding links as well. So that's in the PRISM Academy library. It should say a little library tab, and you can click on that to find those resources. And then for lesson 4, we delve into the buy and sell rules for mutual funds and ETFs. And there's also a buy and sell rules checklist that gives guidelines on what Charles is going to talk about. So it's fantastic.
Great, thanks, Jenna. So now we're going to move on to stocks. And so with stocks, again, we start off with this idea of preferences and constraints. Going back to step 3, but also we're going to incorporate some things when we actually look here at stocks. And one of the things is, do you have a preference in terms of the style? Are you a growth investor? Are you a value investor? Do you want yield, momentum? Perhaps use technical analysis. I saw one study that said our preferences for, say, value or growth are partially ingrained at birth and partially due to our circumstances as we grew up. So some of us are just born value investors, and some of us are just born growth investors, or chartists. If that's who you are, just write it down. Don't try to fit yourself in a, don't try to be the round peg trying to jam yourself into a square hole. If you have a strong preference for a certain style, that's who you are. But I'd also encourage you to think about how much time do you want to spend in terms of picking individual securities? How frequently do you want to trade? Some people don't want to spend a lot of time. Some people are just really buy and hold people. Other people, you like to trade more frequently. They want to have tighter stops to avoid smaller losses. Again, there isn't a right or wrong thing here. Everyone has different personalities and different strategies and approaches work better for different people. So just be cognizant of it, but write it down, incorporate it into your strategy. Um, if taxes are a consideration, you want to build that into your rules. And also some other things, you might have a preference for sustainable investing or other value-based, or perhaps you prefer some type of other value-based strategy. Perhaps you don't want, defense stocks, or you have some religious preferences. Your personal preferences are your personal preferences, but write it down and use those to help guide your investing decisions so you're not spending time on investments that really don't match who you are as an investor. And also, I would ask you to consider thinking about volume. Um, do you want to trade stocks easily? When you place an order in your brokerage account, do you want the trade to occur pretty quickly? Are you okay going with a lower traded stock that might take a little bit longer period of time to actually execute, but might have more potential upside? Again, it comes down to your personal preference. What I will tell you is whatever they are, write them down. And I talked earlier at the beginning of this presentation about the importance of rules. One of the reasons our model shadow stock portfolio has performed so well over the long term is our adherence to rules. Our founder, Jim Clunan, routinely followed the rules for buying and selling stocks for the model shadow stock portfolio. Our president, John Bykowski, who now oversees the model shadow stock portfolio, continues to follow those rules. And this blue line on the chart, the dark navy blue line, line on this chart shows you the performance of the model shadow stock portfolio. Now, some of it is due to the fact that we target the cheapest 10% of all stocks and the smallest 10% of all stocks. The size and the value factor, two of the strongest characteristics of stocks when it comes to outperformance. But we also benefited from having this disciplined approach and continuously following these written rules instead of allowing our emotions to guide our decisions. So that's why we really emphasize rules. Again, as I said at the beginning of this presentation, it will help you realize better returns. So what should go into your rules? I'm going to give you some metrics that you could use to try and set yourself some guidelines. So let's start with valuation. So I'm using here the cheapest 40%. And when you look at the data as to what works well for a factor and what doesn't work well, it's generally cheaper than average for value. And then for things like growth or momentum, it's usually stronger than average. That's why I'm giving you the 40%. And these are the current breakpoints for what is below average. Now, we can come back a year from now and these metrics will change, but it gives you some guidelines where you can set some basic rules that, hey, I want to be a value investor. What's the upper limit in terms of valuation ratios that I should pay? So you can see for price to earnings, it's about 13.4. For price to book, no more than 1.5. For price to cash flow, it's 10.8. If you want to round it to 11.0, that's easy. And for price of sales, about 1.9 or lower. And again, you can round it. You can go with 2.0 if you prefer round numbers. Now, I will point out that you don't have to be precise. Investing is messy. So if you're saying, oh, my PE rule is 13.4, but the stock's 13.7, I don't know. It's okay to have a little wiggle room. But you don't want to say, okay, my limit's 13.4 and this PE is 18. I'm still going to consider it. And when you look at these rules, realize you can blend your rules. You can look for a composite ratio. So for VMQ, which I oversee, and the V in VMQ stands for value, we look for about 6 different valuation ratios, and we actually use a composite valuation by looking at different metrics: price to sales, price to earnings. We look at shareholder yield, uh, EBITDA to enterprise value. So we're combining different values to see how a stock looks across different values. So you can use composite rules if you prefer, but these at least give you some basic criteria you can establish your rules on. Now let's go for growth. Here's some growth metrics you can look at for earnings. When we look at what stocks have had the strongest growth over the last year, it's 53%. And if you're thinking, whoa, that's a big number. Again, this is where timing comes into play, because we're obviously looking at 2021 versus 2020 earnings. And obviously 2020 earnings weren't so great because a large part of the country and a large part of the world shut down because of the COVID pandemic. Came out to last year, economy opened up, people had stimulus money to spend, great year for earnings. So timing does matter when you look at metrics. When you look at 5 years, we're smoothing things out. And so when we look at companies that have above average levels of growth at a 5-year rate, it's about 16%. So going for that mid-teens double digit if you're looking for stronger growth. Same thing with sales, 12-month number, 21%. Again, strong growth because we're looking at year over year. In this case, we're looking at calendar year 2021 versus calendar year 2020. A good year of economic growth versus a year that wasn't so good. But when we look at 5-year growth, we're seeing about 9% growth. Now, one thing I will point out, when you look at these, realize we're looking at EPS growth, so we're looking at per share growth, versus sales growth is really revenue growth for the full company. So if a company's reducing its share count, EPS growth is going to get a boost over sales growth simply because you're looking at pro rata earnings versus sales, you're looking at the company level. So you will often see earnings growth being higher. Obviously, earnings is also affected by accounting decisions management makes in terms of expenditures, in terms of depreciation. So there's a lot of other things that go into earnings, and which is why a lot of people like to look at sales, because it's a cleaner number from an accounting standpoint. But certainly a lot of growth strategies do look at both sales and earnings, and you can incorporate both into your strategy. Now, dividends. I'm sure some of you watching here are interested in terms of dividends. So dividend growth rate. When we look at dividend payers, we're looking at, for the above average dividend growth is about 5% per year. So that's kind of important because you want your dividend growth rate to be in excess of inflation. Otherwise, in real terms, meaning adjusted inflation adjusted terms, if your dividend's only growing at the same rate as inflation, you're just keeping your head above water, but you're not really swimming anywhere. So you really want to have that dividend growth higher than inflation. And when you look at things like companies in the S&P Dividend Aristocrat, sometimes you'll see companies raise dividends by the same dollar amount every year. We saw this at AT&T for years. And the problem is when they raise it by the same dollar amount every year, all of a sudden you say, here's inflation, here's your dividend growth rate. All of a sudden, relative inflation, it gets closer and closer to inflation. On a real basis, your dividend growth slows because they're not increasing the dividend amount over time by enough to outpace inflation. Now for dividend growth, so we have on there twice. Sorry, there's a little error there in the slide. I actually meant to be looking at a longer period, so we'll ignore that second bullet point. But then we look at current yield. So you'll notice why I said highest 80%. And the reason why I use highest 80% is when we look at current yield, it considers the yield for all stocks in the Stock Investor Pro universe. So over 5,000 exchange traded stocks. And most stocks don't pay dividends because most stocks aren't S&P 500. They tend to be smaller, and smaller companies tend not to pay dividends. So we want to look at the highest 80%. And that's really a yield of about 2% or higher. Now, I know those of you who really want yield are saying to yourselves, Charles, that's not very high on an absolute basis. And it hasn't been high for the past few years. Higher dividends, really, so you start looking at dividends at 4 or 5%, often it means there's something risky about the company. Often it means investors are demanding a higher yield because they think the dividend might be at risk of being cut. Now, are there some gems out there because there are some companies that are truly undervalued that are paying a higher yield? Yes, there are, but realize that yield and risk are related. The higher the yield, it's usually a sign that investors perceive higher risk. And the higher level of risk is, the greater the risk is that dividend could be cut. So just keep that in mind, that in this still low interest rate environment, you may not get the yield of stocks you've seen in past years because that's the environment we're in. We're also seeing companies spend a lot of money on buybacks. And buybacks do help increase the share price. But if you want yield, you want that, that cash flow coming in, you don't necessarily get with buybacks. You get higher ownership. But I realize for a lot of you, dividends are very important. So let's talk about momentum. And momentum really refers to relative strength. How does a stock's price performance compare to the price performance of all other stocks over a period of time? In this case, I'm going to actually give you numbers for different metrics, because I could say look for relative strength above 60%. The problem is, if I give you the number, it really means here are the stocks that have outperformed over the last 6 months, 12 months, 4 weeks, whatever period we're using. So in this case, when we look at relative strength, we really want to look at rank. How does the stock's relative performance rank compared to all other stocks? In this case, we want to look at stocks whose relative strength is better than at least 70% of all stocks. And this is we actually see this used in some of our screens. Our CanSum approach, for instance, we actually see stocks trading within 90% of the 52-week high. So those of you who are fans of William O'Neill will know one of his criteria is he wants to find stocks that are trading close to their 52-week highs. In our VMQ portfolio, and the M in VMQ stands for momentum, we use a weighted 4-quarter relative strength rank of at least 60%. So stocks that have stocks with above average weighted relative strength over the last 4 quarters. And that's a mouthful. So just real quick, what we do with relative strength, and this is the same momentum indicator we use in A+ Investor, is we're applying a 40% weight to stocks price performance over the most recent quarter, and then we're individually applying a 20% rank to stocks price performance over each of the past 3 previous quarters. So it's a weighted average, and we find stocks that tend to have above average performance go on to continue outperforming. And so the whole idea about momentum is you want to find stocks that have above average price performance relative to all other stocks. And again, some strategies do use as an absolute basis where they're looking for stocks price performance to be, or stocks price to be within X% of a certain benchmark, such as CanSum within 10% of the 52-week high. So there's some metrics you can use to set rules for buying a stock. Now, what about selling a stock? Well, the golden rule is to sell a stock when it no longer matches the reasons you bought it. For instance, you buy a value stock and it becomes expensive. That would be a reason to buy it. You have a growth stock and you're buying because of double-digit growth, and all of a sudden now, the company blows its strategy and now its sales are dropping. That would be a reason to sell it. If you're a dividend investor and a company cuts the dividend, run, don't walk away, because dividend cutters tend to have underperforming prices. So that would be the key reason. But depending on how strictly you want to follow your strategy, you may want to actually give your stocks room to run, and that's what we do with our portfolios at AAII. When a stock no longer meets a buy criteria, we don't immediately sell it. We actually have a middle ground where we have, okay, the stock qualifies for purchase, and then it no longer qualifies for purchase, but it hasn't met our sell rules, so we give it room to run. So for instance, if you're a value investor, all of a sudden the stock's not as cheap as you would like for your buy rules. It may still have potential upside if you give it room to run, but just make sure you set a ceiling at which you might sell it. So maybe you buy the stock when its PE is, say, no higher than 13.5, but then perhaps you set some upper limit. Maybe it's a PE of 15, maybe it's a PE of 18. So you're allowing the stock the chance to run upwards, and you're getting some of the upward momentum, but you're going to pull your money out of it before it gets overly expensive. Some other basic rules we use: if a company stops being profitable in all our portfolios, that will make it a candidate for selling. Again, the dividends cut. If there's been a negative change in the business, a change in the strategy, conditions have really gotten bad, that might be a reason to sell it. But also, if you're someone who likes to use stop prices, it hits your stop price. So, going back to CanSlim, I'm just using this as an example because it's very familiar to a lot of people. You might say, I'm going to sell it if the stock drops 8%. I've seen people use 20%. I've seen people use 30%. I've yet to see a single rule that says this is the magical downside you should set a stop at. That applies to all strategies. But if having a certain percentage drop from your purchase price allows you to sleep at night, go ahead and do it. But the one thing I would caution you is to have an open stop order in your brokerage account to sell if the price falls to X amount. I'd rather suggest you set price alerts. So the stock drops to your stop limit, it gives you a chance to stop and take a look at what's going on. Is there anything unusual going on? Is there any news that might cause you not to sell? So just give yourself the option to at least look and see what's going on. And if the stock's clearly violated your stop rule and you don't find anything unusual that might give you a reason not to sell stock right that moment, go ahead and do it. But at least it gives you a chance to spend a few minutes in investigating, again, in a disciplined and a very tight fashion when you do that. Now, as far as finding stocks, how do you find good stocks? Well, all AAII members have access to our approximate 60 stock screeners and stock screens. And I'm a big fan of stock screening because it leads you to stocks you may have never heard of that match your style of investing. You can also take advantage of our model shadow stock portfolio, which I talked about a few minutes ago. This, again, is open to all AAII members. Our investing ideas page has different stocks and gives you different stocks ideas that you can find on it. On AAII.com, just click on investing ideas from the top. Our stock evaluator, you can access our stock evaluator by simply just typing in a company name or ticker symbol into the search box. You can also find information on mutual funds or ETFs, our mutual fund evaluator, our stock evaluator. You can actually find those by simply typing in a name or ticker symbol into the search box on top of AAII.com. If you are an A+ investor or an AAII Platinum subscriber, you can use our custom stock screener on AAII.com to build your own screen. So just to be clear to everybody, so our stock screens are pre-built strategies. We have approximately 60 of those. Those are available to all AAII members. AAII members get to see the results updated at the start of every month. A+ subscribers and AAII Platinum subscribers get to see the results updated daily. And A+ and AAII Platinum subscribers can also take advantage of our custom stock screener. For those of you who use our Stock Investor Pro screening program, our custom screener has some of the features of SI Pro, but not all the features. SI Pro has some features in it that custom stock screener doesn't have, but it's in our project plan to actually build a web-based platform for SI Pro. So you actually will in the future be able to actually use SI Pro on the web. I can't give you a timeline for when that's going to happen, but that is on the project plan. And Jenna, I know we have a lot about stocks in our PRISM Academy as well, about helping people find the right stocks and set the rules for them. for governing how they'll buy and sell.
Exactly. We do encourage our members to go into the community for lessons 5 through 10, which focuses on different aspects of selecting stocks for your portfolio. So lesson 5 actually is best focused on narrowing down the stock universe. Since there's so many, there's over 5,000 US exchange listed stocks, this actually helps you break it down and take a look at what your preferences are and how these will actually affect what you put into your portfolio, like Charles has mentioned. There is a checklist in there to go through. It asks you about 10 questions. They're pretty quick to go through, just to basically reflect and think about what is actually going to benefit you in the long run. Lesson 6 is focused on finding a stock and where to start. So similar to the mutual fund and ETFs section, we have a checklist that goes through all the different resources that Charles just mentioned, and there's links actually in those as well. So you can find that, like I said, in the PRISM Online Academy in the library section, or attached to the lesson 6 in the lesson itself. And then for lesson 7 through 10, we actually since there's so much content on different ways in different buy and sell rules and guidelines for you, we actually broke those down to 3 different lessons. And these will actually focus on the investing styles, like Charles mentioned, momentum, value, growth, and income. And that will also be a checklist that you can go through and create and basically use those guidelines to create your own buy and sell rules.
Great, thanks, Jenna. Okay, so now we're going to move to the last section, which is bonds and cash equivalents. So what do you do with a portion of your portfolio that you're using for, the buffer, the volatility of stocks? And so again, it comes down to constraints. How much do you allocate to quote unquote safer assets, ones that are less volatile in terms of price? This starts with your allocation need. What goals you're trying to meet? What's your tolerance for risk? Some of the people watching, I know, are going to be almost fully allocated to stocks. Others of you will have a high allocation to bonds. Our moderate allocation is 60-40, 60% stocks, 40% bonds. And what I will say in the current interest rate environment, don't be afraid to be a little creative, but do think about the timing of your cash flows and why you're holding bonds and cash equivalents. Are you trying to, longer term buffer for your portfolio against the volatility of stocks? Are you trying to provide a source of cash flow? Or are you perhaps having buffer asset to maybe you're taking your retirement, you're taking withdrawals, and you want to have a set aside of safer assets. So should stocks fall at some point, you're not having to sell stocks, say during a market correction or a down market. So think about what your role of the safer part of your portfolio is. And when I refer to safer, I really mean in terms of lower volatility portion of your portfolio. And again, you'll see on here, if tax efficiency matters, you do want to consider that. So let's talk, first of all, just taking a step back. Okay, 60-40 portfolio. I'm going to use this as a simple example. 6% stocks, 40% bonds. Traditionally, this portfolio is large cap stocks and intermediate to longer term bonds. But let's set the stock side aside. Let's focus on that 40%. Realize you do have a lot of options, and depending on your needs and in the current interest rate environment, you want to think about what can you actually have in it. You do not necessarily need to hold long-term bonds or intermediate-term bonds. You can, for instance, hold individual bonds and hold them to maturity. And this particularly works if you have defined dates you want to meet. And a nice thing about buying individual bonds is you get a known return at purchase. Because at the time you purchase the bond, from that point to maturity, it's really what are you going to receive in interest payments relative to what you paid, and then how much you're going to get back from the bond. And generally, most bonds in the U.S. trade at a par value of 1,000. So basically, your capital gain or loss is your purchase price for the bond, minus $1,000. Bond funds, the advantage about using bond funds is you get easy diversification. You get a diversified portfolio of bonds. Defined maturity bond funds. I find these really interesting, and I've written about them in the AAII journal. These mature like bonds do, but they give you access to a diversified portfolio of bonds like bond funds do. So it's a hybrid, and it actually can work well because you can actually ladder them like bonds. But again, anytime you get a hybrid, you do have some trade-offs. You could actually, ladder CDs. So if perhaps you're really worried about bonds falling on prices, you could actually use CDs instead of using bonds, particularly for shorter term needs. And you can always just use a money market account. The advantage about money market accounts, if you buy one with a fixed value, it's pegged to $1, so you won't lose any money. Now, granted, on real terms, you're not going to get as high as an interest rate as you might get elsewhere, so you do run a risk of losing out to inflation. But if safety of capital is of utmost importance to you, a money market fund can be a consideration. So one thing with bonds, you have to realize there's two big drivers of prices. One is maturity. How far in the future is the bond going to mature? And under normal circumstances, normal economic circumstances, the longer in the future the bond is going to mature, the more investors are going to demand and higher interest rates and in terms of yield. The reason why is if you're going to ask me to lock up my money for 10 years instead of 5 years, I'm going to say, well, I want more interest, a higher yield to lock my money for 10 years versus 5 years because I want to be without access to my cash for a longer period of time. And I know there's going to be inflation. So give me higher compensation. Now, the reason why I say under normal economic conditions, when the bond markets are fearful about a recession occurring, we have what's known as inversion in the yield curve occurring, which means you will see yields on longer dated bonds actually fall below those of shorter dated bonds. And I talk about it in today's investor updates, where I talk about what's going on with the yield curve. And so you can see that in my investor update commentary. But in general rules, the further out to maturity, the higher the yield you should expect and the higher the yield you should get. The other big driver is credit quality. And in simple terms, the riskier the bond in terms of credit quality, the higher the yield, because investors want more income now as compensation for the risk of the issuer defaulting. As a general rule, most investors should stay within the realm of investment grade. Yes, the yield's lower, but it's a lower risk of default. And you can see on the slide here what defines investment grade. If you want to be more aggressive, you could look into high yield category, aka junk, but make sure you're staying, more in the B range of bonds. Because you start getting to C or lower, you really have a much higher risk of the bond issuer defaulting. And in default, there's always a chance you may not get the full par value of the bond back. So if you want higher yield and you're willing to more volatility, you can do it, but just realize you're also taking on a higher risk of default. The other thing to consider in bonds is taxation, how they're taxed. So as you can see here on the slide, treasury bonds are taxed at the federal level, but not the state and local level. Municipal bonds are not taxed at all, but they can influence what you pay in Medicare Part B premiums, and they can affect how much of your Social Security benefits are taxed as well. Corporate bonds are taxed at the federal and state and local level. So corporate bonds, if you're going to hold them, you may want to consider holding them in a tax preferred account, such as an IRA or a Roth IRA. And I know a lot of people are thinking, well, that's where I hold my assets, where I want long-term growth of capital in. Yes, I understand that. But if you're holding corporate bonds, particularly as a buffer, from a tax standpoint, you might actually want to consider holding them in a tax preferred account, taking advantage of what's known as asset location. So on the yields, particularly the yields we're getting right now, you're not having the tax man take a larger chunk out of those returns. So buy and sell rules for bonds. Again, determine what kind of bond you want, both in terms of taxation preferences, credit quality, but also maturity. And then plan on holding the bond to maturity. That way you'll get a known return. And decide in advance, are you going to invest in coupon payments or are you going to reinvest them? That'll affect your strategy. And particularly if you're looking at a bond ladder or you're trying to match your bonds with when you might have certain, outflows needed. Perhaps, on certain dates you're planning on making certain expenditures, you can match bond maturity dates up with those expenditures. But if the credit quality worsens, that would be a time where you may want to consider selling the bond. Now, what about bond funds? In general, the same rule applies, particularly looking for lower expense ratios. But when you look at bond funds, within the categories, realize that usually when you see higher returns, it usually means the manager's taking on higher risk within its category. Because the way you get higher returns on a portfolio of bonds is you're either taking longer maturities, you're taking higher credit risk, or you're doing both. So if you see a higher return, you may want to look at the category risk ratio, and is that higher than the peers? Is it above average than the peers? If so, it means the bond fund manager is taking on more risk to get that higher return or that higher yield. And then you need to decide your comfort level with that. And Jenna, I know we have more about bonds in PRISM Academy.
Yes, so we haven't released these lessons yet. These are coming in the next few weeks, but we will release lessons 11 through 13, which will cover various aspects of selecting bonds for your portfolio. So lesson 11 is narrowing down the bond universe, which provides members with a checklist for how to create a manageable list of potential bonds to add to your portfolio. And then lesson 12 will be finding a bond, where to start, which will have specific guidelines on how to start researching which bonds would be good portfolio additions based on your preferences and your allocation. And then lesson 13, we'll delve into the buy and sell and hold rules for bonds, which will be a checklist on the various buy, sell, and hold suggestions so that you can use those to create your own rules before investing in bonds. So those will be released in the next few weeks. So check back. But right now we're on the stock section, so you can go in there anytime and start participating.
Absolutely. And so I know what we're going to do next month, we go through the PRISM process PRISM steps every month now. And so what we'll do next month will be our step 5, which is monitoring your portfolio. So we talked about buying and selling. So we get to the portfolio management process. And we actually not only includes portfolio management, but look considering your goals, where you're as an investor. We'll get to that. Well, April, I guess April starts tomorrow. So right around the corner. And Jenna, do you want to talk about community?
Yeah, definitely. So I do want to encourage all of our members to get it into the PRISM Academy online and try out everything that we have on there. We have such a large library of resources for members to take advantage of. We have checklists and guides and intro videos, and we'll also be posting in the webinars. So if you happen to miss this, or you'd like a friend to watch what we've been talking about, how to select certain investments for your portfolio, then you can share that with them. We always encourage everybody if you have friends or family members, bring them into the PRISM Academy, because we have a lot of materials and a lot of resources, and we're still building. We have the rest of S to cover, which will be in the next few weeks, and then around I think April 28th, we'll start wrapping up and we'll get into M, which is our final step of the PRISM process. So it's very exciting, which is monitoring your life stages, progress, and allocation. So you'll want to make sure that you can start at step 1P, prioritizing your goals, and go all the way through at your leisure, whatever lessons you want to delve into a little bit more or get more information on. You can do that at your convenience. So I encourage everybody, you can go to www.aaii.com/learn-and-plan, and you can start, and you can click down into which section or which lesson you want to go into. You can also visit community.aaii.com and go straight to the community as well, since we have a lot of exciting community resources and groups as well. And just to kind of give you an idea of what it looks like, you can see on the right side, that's the AAII PRISM Academy syllabus. So you'll be able to see that on the home page once you get into the AAII community. And then basically, PRISM is an interactive experience. We're asking you lots of different discussion questions. Actually, in this specific section for step 4, we are, oh, Charles, I think we lost you again. Oh no. Well, I'll continue and I'll wrap it up. The section on PRISM Wealth Building Academy. So basically, we have customizable worksheets, instructional videos and tools, community forums to share ideas and discuss PRISM with other AAII members as well. So there's just so much there for everybody that you can take advantage of and kind of delve into at your leisure. So for selecting and managing your investments, right now, today we released lesson 6, which was finding a stock where to start. And then next week will be lesson 7 through 10, which will focus on the buy and sell rules for stocks with those guidelines, delving into all the different investing styles, such as value, momentum, growth, and income. And then the week of April 14th, we'll have both lessons 11 and 12 released. So we'll have narrowing down the bond universe and finding a bond where to start. And then for April 21st, we'll have lesson 13 and 14, which will wrap up the entire course, and which will be the buy and sell and hold rules for bonds and the importance of writing down your buy and sell rules. And like I said, on April 28th, we'll debut lesson 1 of monitoring your allocation progress and life stages.
Okay, and just a few final thoughts. And again, thanks for those of you who stayed on. Sorry for the issues we had right here at the very end. But a few final thoughts. Just again, this concept of just writing down your rules. Writing down your rules and following them will lead you to making more disciplined and less emotional decisions. Even if your rules are really simple, as long as you write them down and you follow them time after time after time, you'll get better returns. Another thing is when you're investigating an investment, having a simple checklist. I need to look at the income statement. I want to go look at the company's IR section of their website. I want to, maybe you want to look at certain research reports, whatever you think are key things you want to look at in a stock. And again, it might be a chart. Write those things down on a checklist. So every time you go to analyze a stock or analyze a fund or analyze a bond, you're doing those things over and over again. Again, that disciplined process. As I said earlier, I mentioned that we have over 60 stock screens on AAII.com. I'm a huge proponent of using stock screens. I've used them long before I joined AAII. I won't say how many years because I'll start to feel old if I do, but they do a great job of finding stocks you've never heard of that have the characteristics you desire in a stock. So take advantage of those. And finally, realize that if you have good rules, your investing success is going to come from trusting the strategy. Your strategy is less emotional. You put thought into it. So rely on it. It will help you realize good long-term returns. Jenna, do we have any questions before I blank out again?
Yes, we'll do them quickly. So, just in case of anything.
Sure. Absolutely.
So the first question is, where does one find the R-squared value of a fund?
So you can actually find that in our mutual fund guide, in our ETF guide that's actually included in there. I think we also have it on our stock and evaluator pages. So if you just type in a ticker or a fund name into the search bar on AAII.com, I believe we actually do have it on that page as well.
Excellent, excellent. And on the topic of funds, does the PRISM system give guidelines on trading options on ETFs?
We do not, but you certainly, on our rules section, we actually have a blank part in there where you can put things in there. So if options are your desire, you certainly can do that. I'm not a big options trader myself, but if you want to use options, I would suggest you consider rules. And obviously part of those rules, you want to think about what type of stock you're going to buy an option on. That's probably your first rule, is having those rules for type of stocks. And then obviously when you get to options, you may want to think about things such as delta, in the money, out of the money, the time component in terms of how far out to expiration you want to buy. Certainly those things, think about that and put it in there. And obviously the options, the strategies, when you start getting the spreads and butterflies, the strategies get pretty complex pretty quickly. So if you're looking at something like that, make sure you write that down as well.
Makes sense. And Carol asked, would the model shadow stock rules work for investing in individual small stocks inside an IRA account versus investing in small cap fund, mutual, or ETF?
Yeah, absolutely. And so you can use the model shadow stock portfolio in really any type of stock account, whether it's an IRA, a Roth IRA, or a traditional brokerage account. So it works on any of those types of accounts. It is a low turnover strategy, so it does work well in a taxable account. But since our goal is to realize big gains, if you have it in an IRA or a Roth IRA or some type of similar type of retirement savings account, you won't pay taxes on those capital gains when they're realized.
And we'll switch over to kind of the individual stocks. We have a question from Douglas. Do you disagree with the evidence that buying individual stocks results in uncompensated risk?
You know, I don't. I think it really depends on what your approach is and whether or not you're disciplined. But I think the other thing is when you're buying individual stocks, I don't think you should just buy one or two. If you're going to primarily hold stocks in your portfolio, you should diversify. And our portfolios, we usually recommend holding at least 10. I think you should really think about probably at least 15 to 20 to get that diversification and make sure they're different. I mean, you don't want to holding 15 semiconductor stocks is not being diversified. You want to make sure you diversify across company risk and, of course, sector risk, and really even market cap risk. You want to make sure you diversify, but keep in mind the one thing you are including that when you do invest in stocks on an individual basis, you are incorporating your own behavioral risk into it. So there is a layer of risk involved. But then if you're using an actively managed fund manager, you're taking on their psychological and their behavioral biases, so you're not completely avoiding it in that aspect either.
Those are good suggestions. And as far as bonds, we had Jerome ask a question. So Treasury I bonds have become, attractive, and rates are declared on 6-month intervals. The next declaration will be made in May for the 6 months through October. If I bought an I bond in January, will the rate change? Change only after 6 months, or will the rate change in May?
You know, I don't know the answer to that question. We're actually have an article and it's in my inbox. I need to reread it and re-edit it. But we're targeting an article about I bonds, I believe, for the June issue. So obviously, it's not going to help your question right now. I don't know the answer. I would suggest going to treasury.gov. They should have the answer on it. But if you can't find it, I'll give you my email, charles@aai.com, and I'll email the author of the article we have slated for later this year and see if I can't get you an answer from him.
Excellent, excellent. And Mike asked, we've talked about, the current world events and how they play a really big impact on, our portfolio. So have you adjusted your current recommendations based on these current world events or circumstances?
No, I have not, because there's always going to be something that's going on in the world. And often what happens in the future is something we don't expect. We can go back, 2 years ago and look at the Barron's Roundtable from January 2020, and they gather a roundtable of investing professionals. And some people were saying, yeah, we're watching the pandemic, it could be an issue, not really sure. Even last year, no one was talking about Putin invading Ukraine, and so when we start looking out 3 or 4 years ago, it's going to be something else. And so I don't react to world events. Obviously, they're an issue, and when I'm screening for stocks, certainly those world events start coming into play because they affect what's passing the screen. For instance, I was looking at VMQ today. We're about to make a portfolio change for that. And I happen to see a lot of steel stocks show up because steel prices have risen. That's pushed up the price momentum of steel stocks. So I do see that in terms of my screens and what stocks I'm going to select. But individually, I don't make any changes to my portfolio directly on what's happening. I just let the strategy evolve and let the strategies tell me, okay, in this situation, in the world environment, your rules are calling up these types of stocks. And so that's how my portfolio, both my portfolio and how the VMQ portfolio, which I oversee, evolves.
Excellent, excellent. And we just had a couple of people actually, Patricia, Ronald, John, they all said that, they were asking about that. They're interested in learning about the I bond, so they appreciate reaching out, and they're looking forward to the article in June for more information.
Oh,
I think
great.
that's about it, though. Yeah, and I think that's about it right now. And just a reminder, if you guys have any other questions later on that come to mind, or if you watch the replay and then you think of something, you can always email members@aai.com, or you can go into the Prism community and actually type your question directly to me or Charles, and we'll get back to you, as speedy as we can.
Absolutely. If you type in a community, realize you're also helping other members that might have the same question as well.
Exactly, exactly. And so I did want to just, since we're wrapping up is there anything last minute that you want to talk about, Charles, or should I go into upcoming webinars?
Well, let's get upcoming webinars. Well, just remind people again, just this idea of having a systematic process you keep following. I know I'm beating the drum here, but it really does make a massive difference.
Yes.
Okay, I'll go
And
here
for
to
upcoming
upcoming
webinars,
webinars.
awesome, thanks, Charles. So
Mhm.
for upcoming webinars, we have the Individual Investor Show on April 7th, which is called Finding Your Own Winning Portfolio Strategy. And that will be at 4:30 p.m. Central. And that you can also, if you subscribe to YouTube or one of your favorite podcast platforms, such as Spotify, Apple Podcasts, Amazon Music, Audible, etc., you'll be able to, you'll actually get notified as soon as we release that episode at 4:30. And then on April 13th, we have the AAII Expert Roundtable, which is, it's also called Using AAII's Premium Services to Navigate 2022 and Beyond. And that will be at 1 p.m. Central. And you can always, to view and register upcoming webinars visit aaii.com/webinars. And before we wrap up our presentation, we'd like to take a moment to thank our sponsor, Discover Bank, with a quick video.
And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aaii.discoverbank.com to learn more.
And I just wanted to reiterate that so through Discover Bank, AAII members can save with high yield CDs, savings accounts, money market accounts, and IRA CDs. Our partnership with Discover Bank gives our members exclusive preferred rates on all of their products. And you can visit AAII.com/savings products to learn more. And I want to thank everyone for attending tonight's webinar. Lastly, I wanted to mention again that this presentation was recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources we discussed. And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and take care.